This is a discussion about classified cash flow statements. On the screen are two cash flow statements for the same business, the same period of time. The top one is unclassified and the bottom one is classified. Let's look at these in a bit more detail. This top one is sometimes called a statement of receipts and payments. It just lists the cash receipts in no particular order, less the cash payments in no particular order, and it works out the cash balance at the end, which in this case is $20,180. This is the standard unclassified cash flow statement. On the bottom is the classified cash flow statement. Exactly the same business, same period of time, but the information in the cash flow statement is now classified. That is, we group together cash information that has a particular characteristic. And in the cash flow statement, there are three classifications or three subheadings: operating activities, investing activities, and financing activities. So all of the information in this standard cash flow statement up here can be presented in a classified format so that stakeholders can be provided with additional or higher quality information about the cash in and out of the business. What are operating activities? Operating activities refers to the business's day-to-day cash flows. Most cash flows in a business will be classified as operating types of activities. And so they're listed as operating activities, and the positives, that is the cash inflows, always are listed first. So in this case we have takings of $50,000 and the GST on those takings $5,000. Both of those are positive figures. They are listed first. They're classified as operating activities. And then you list the negative operating activity, that is the cash payments that are classified as operating activities. And in this particular case, rent is classified as an operating activity negative, so we put brackets around the figure. Wages, brackets around the figure, or you could put in a minus sign, but brackets are preferred. Interest on a loan is a negative operating activity, and GST payments, that's a common one, a negative operating activity. So you add up the positives, you take away the negatives, and you come up with a net figure for operating activities. So in this particular business, $45,180 was the net cash inflow from operating activities. The positives less the negatives to give the net figure. The second category is investing activities. When you see that term investing activities, think non-current assets, because investing activities refers to the cash flows associated with non-current assets. That is, those assets that the business expects to hold for more than 12 months. In this business, there is only one item that would be classified as an investing activity, and that's the new vehicle. A vehicle for the business is a non-current asset. $40,000, it's an outflow, so it's in brackets, and so it is the same thing as the total net outflow of $40,000. Often there'll only be one item, if at all, in the investing activities section. $40,000, that was the acquisition of a new vehicle for cash, so the net inflow from investing is negative $40,000. And the last subheading is financing activities. And financing activities refers to the cash flows related to the owner, capital injections and the drawings, and any loans or repayments of loans. So we have capital contribution $3,000, $11,000 borrowings from a bank, in this case the ANZ, and in this case there was drawings of the owner $3,400 negative, of course, because it's a cash outflow, and the repayments of the loan principal $1,600 as a negative. So inflows, capital and loans, outflows, drawings, and the loan repayments in brackets to get a net figure, $9,000 positive. You then add up the three subtotals, and you come up with a total change in cash for the period, $14,180, exactly the same as up in this other one, $14,180. You add the cash at the start, and of course you get the same cash at the end, $20,180.